A professional trader understands the same principle that keeps casinos profitable. Each individual event has a random outcome, yet over many events, the statistical edge produces consistent results. The casino does not need to know what the next card will be. It only needs confidence in its edge and the discipline to execute the game repeatedly. Trading operates under the same structure. Consistency emerges not from prediction, but from repeatedly acting on a valid edge while accepting the uncertainty of every individual outcome. The foundation of this mindset is the belief that anything can happen in the market. This is not a casual statement, but a deeply internalized truth. Every moment in the market is unique. Even if two situations appear identical, they are never truly the same because the underlying order flow, participants, and timing are always different. When a trader genuinely accepts the uniqueness of each moment, the need to predict disappears and is replaced with the responsibility to execute an edge with discipline. The difficulty arises because the human mind is naturally designed to think in associations. It constantly compares the present moment with past experiences stored in memory. When a trader experiences several winning trades in a row, the mind links the next opportunity to those past wins. This association creates emotional states such as excitement or even euphoria, which distort perception and can lead to impulsive decisions, early entries, or poor risk management. The same mechanism works in the opposite direction. After several losing trades, the mind automatically associates the next opportunity with previous losses. Fear becomes dominant, and the trader may hesitate, skip valid setups, or second-guess the edge. In both cases, the trader is no longer responding to the present market, but to emotional residue from the past. This is how psychological bias interferes with the probabilistic nature of trading. Subscribe to Live Trading Mindset and follow the real journey of becoming a disciplined trader. Here we document the psychology behind every trade, the mistakes, the lessons, and the process of building consistency in the markets. If you are serious about trading and working on your mindset, this channel is for you. A disciplined trader understands that the outcome of the next trade is unknown and unknowable. Accepting this uncertainty is not weakness but a source of power. Just as the casino does not need to know the result of the next spin of the roulette wheel, the trader does not need certainty about the next trade. The only requirement is consistent execution of a proven edge over a large sample of trades. The moment a trader believes they must know what will happen next, the mind becomes vulnerable to error. The desire for certainty leads to overconfidence after wins and avoidance after losses. Both reactions break discipline and disrupt the statistical process that produces consistent results. Mastery in trading, therefore, comes from aligning behavior with probabilities rather than trying to eliminate uncertainty. Consistent trading begins with accepting that every moment in the market is unique, change is constant. At the most fundamental level, every atom and molecule in existence is in motion, and motion over time produces change. For two moments to be identical, every particle in the universe would have to return to the exact same position it held before. That is effectively impossible. When a trader accepts this idea, it becomes easier to detach from past outcomes and approach the market with openness rather than expectation. This belief helps counteract the automatic mechanism of the human mind. The brain is designed to interpret the present by referencing the past. It searches for patterns and similarities, then projects those associations forward. In trading, this mechanism creates the illusion of certainty. A trader believes they know what will happen next because the current setup resembles something that happened before. In reality, the present situation may only look similar while the underlying conditions are completely different. When traders fail to recognize the uniqueness of each moment, they begin reacting to their beliefs instead of the market itself. Their interpretation becomes stronger than the information in front of them. What they think is happening replaces what is actually happening. This gap between perception and reality is where most trading errors originate. The trader is not responding to probabilities, but to an internal narrative shaped by memory, emotion, and expectation. A simple real-world example illustrates how powerful belief can be in shaping perception. Imagine a person standing on a busy street holding a sign that clearly says "free money today only." Logically, people who can read the sign and value money should approach immediately. Yet many individuals walk past without asking for anything. Their behavior reveals that they do not truly believe the offer is real, even though the information is clearly presented. Belief determines how information is interpreted and how behavior unfolds. People often filter reality through assumptions about what is possible or impossible. If something conflicts with those beliefs, they ignore it or reinterpret it. The same psychological process happens in trading. A trader may see a valid opportunity but ignore it because prior losses have convinced them the next trade will fail. For this reason, trader psychology is ultimately about managing beliefs. When a trader fully accepts uncertainty and the uniqueness of every moment, the mind stops trying to force certainty onto the market. Instead of predicting outcomes, the trader focuses on executing their edge consistently. Behavior becomes aligned with probability rather than belief, and this alignment is the foundation of long-term consistency. Human behavior always reflects underlying belief. It takes energy to act, speak, or respond to the environment, and that energy will always flow in a direction that is consistent with what a person believes to be true. Because of this, behavior becomes a visible expression of internal belief structures. If someone reacts to a situation in a certain way, it is possible to trace that reaction back to the belief that made the behavior feel logical, justified, and appropriate in that moment. In the example of the man offering free money, people who walked past him revealed a very clear belief. Even though the sign openly stated that money was available, their internal belief that free money does not exist overpowered the information directly in front of them. Their minds rejected the evidence because it conflicted with what they believed to be true. As a result, they behaved in a way that protected their belief rather than exploring the possibility that the situation might actually be real. When the mind encounters information that contradicts an existing belief, it experiences psychological conflict. Human beings naturally try to eliminate that conflict as quickly as possible. One common way the mind resolves it is by reinterpreting the situation in a way that preserves the original belief. Instead of accepting that free money might exist in that moment, people concluded that the man must be irrational or dangerous. This interpretation removed the conflict and justified avoiding him entirely. This process also reveals how beliefs generate emotional states. A belief can activate either positive or negative energy. Confidence represents a positive state of mind, while fear represents a negative one. In the example, individuals who believed the situation was suspicious experienced fear and moved away. Their interpretation triggered a protective emotional response. Their behavior was not based on objective reality, but on the emotional state created by their belief. The same psychological mechanism operates in trading. A trader's beliefs determine whether market information produces confidence or fear. Two traders can look at the same chart and react completely differently because their beliefs interpret the information differently. One trader may see opportunity and execute the edge with calm confidence, while another sees risk and hesitation because past experiences have conditioned them to expect loss. Consistent trading therefore requires deliberate change at the belief level. The trader must install beliefs that align with the true nature of markets. When beliefs reflect the probabilistic structure of trading, the mind stops resisting uncertainty. Confidence becomes stable rather than emotional, and decisions become consistent. In this way, consistency in results begins as consistency in mindset, built on beliefs that support disciplined execution rather than fear. When the person who received the $20 goes home and tells the story, the first words will likely be, "You won't believe what happened." Those words reveal something important. They acknowledge that the experience contradicts common belief. Most people listening will reject the story because their belief system insists that free money does not exist. The experience may be real, but belief determines whether others accept or deny the possibility that it actually occurred. Even the person who received the money can experience a sudden shift in emotional state. At first, he may feel positive and energized because he encountered an unexpected opportunity. However, someone might ask a simple question: "Why didn't you ask for more?" The moment that thought appears, the emotional state can flip from satisfaction to regret. What was originally a positive surprise becomes a perceived missed opportunity, instantly turning a positive state of mind into a negative one. This example highlights why negative mental states are so destructive for traders. Fear, regret, and anxiety distort perception. A trader can still produce winning trades while operating under these emotions, but the real danger lies elsewhere. Negative states create the conditions for large and damaging drawdowns. The trader loses the ability to stay balanced and objective, and decisions become driven by emotional pressure instead of disciplined execution. Fear has a very specific psychological effect. It narrows the focus of attention onto the object of the fear. Instead of seeing the full range of information available in the market, the trader begins filtering information through the lens of what they want to avoid. Ironically, this narrowing of perception often causes the trader to create the very outcome they fear most. The emotional response begins shaping behavior in ways that sabotage objective decision-making. If a trader fears being wrong, they will unconsciously gather only the evidence that confirms their position. If they fear losing money, they may hesitate, exit too early, or avoid valid opportunities. If they fear missing out, they chase the market and enter trades impulsively. If they fear leaving money on the table, they hold positions too long. In every case, the trader is no longer responding to the market, but to the emotional interpretation created by fear. Greed is often misunderstood, but operates in a similar way. At its core, greed is driven by the fear that there will not be enough opportunity in the future. This belief creates urgency and pushes traders to force trades that do not align with their edge. When traders believe opportunities are scarce, they abandon patience and discipline. The correct mindset, however, recognizes that markets continuously produce opportunities, allowing the trader to act calmly and selectively. A trader must accept that the outcome of any individual trade is unknown. A price level may have previously attracted buyers who push the market higher, but there is no guarantee those same participants will appear again. Market conditions constantly change. The only practical responsibility of the trader is to define risk. The question is not whether the trade will work, but how much room the market is allowed before the probability of the setup is no longer valid. Fear interferes with this process. When a trader is afraid of being wrong, defining risk becomes psychologically difficult. Risk definition forces the trader to accept the possibility that the trade may fail. Instead of approaching the trade as a probability event, the trader interprets it as a test of being right or wrong. This shifts the emotional meaning of the trade and activates the fear associated with past experiences of failure. Once fear enters the decision process, perception begins to change. The market only produces upticks and downticks that form patterns. Yet the fearful trader does not interpret this information objectively. Fear narrows attention toward whatever information appears to confirm the desired outcome. If the trader is long, the mind begins focusing on the upticks while minimizing or ignoring the significance of the downticks. This selective perception is driven by the mind's automatic pain avoidance mechanism. Just as the body instinctively pulls away from physical pain, the mind attempts to avoid psychological pain. Information that suggests the trade is failing threatens the trader with the emotional discomfort of being wrong. To avoid that discomfort, the mind unconsciously filters the information, making the warning signals appear less important or even invisible. This mechanism becomes extremely dangerous in trading because the market cannot be controlled. In everyday life, people often avoid uncomfortable feedback by controlling their environment or influencing others. Traders do not have that option. The market continues to provide information regardless of the trader's emotional comfort. If the trader refuses to process that information objectively, the position can move further against them while they remain psychologically trapped in denial. Eventually, the trader exits the trade only when the emotional pressure becomes unbearable. By that point, the loss is often far larger than it needed to be. The trader waited for emotional certainty instead of following a predefined risk boundary. Consistent traders solve this problem by accepting uncertainty in advance, defining risk objectively, and allowing the market to determine whether the trade works without personalizing the outcome. When a trader refuses to exit a losing trade, two fears are competing inside the mind. One is the fear of admitting that the trade was wrong. The other is the fear of losing money. At first, the fear of being wrong dominates, so the trader stays in the position. But as the market moves further against the trade, the fear of losing additional money grows stronger. Eventually, that fear becomes slightly greater than the fear of admitting the mistake, and only then does the trader finally exit. What makes this dynamic so dangerous is that fear distorts perception. While the trader is trapped in the losing position, the market may clearly be forming a strong trend. Under normal circumstances, the trader would easily recognize that pattern. Yet in the emotional context of the trade, the mind becomes blind to it. Fear of being wrong creates perceptual blindness, preventing the trader from recognizing the very information that could have allowed them to reverse the position or avoid the loss. The same distortion occurs in winning trades, but in the opposite direction. When a position moves in favor of the trader, another fear appears, the fear of leaving money on the table. Every small pullback begins to feel threatening. The trader interprets normal fluctuations as signs that profits will disappear. Instead of recognizing that the market may be trending strongly, the trader exits prematurely in order to protect the existing gain. This dynamic explains the common behavior of cutting profits short while letting losses run. It is not primarily a problem of strategy, but of perception shaped by fear. The mind narrows its focus onto whatever confirms the feared outcome. In losing trades, the trader ignores danger signals that require admitting a mistake. In winning trades, the trader exaggerates danger signals that suggest profits might disappear. True consistency requires reaching a mental state where market information remains emotionally neutral. Price movement itself has no inherent meaning. Upticks and downticks are simply information. The problem arises when traders attach emotional significance to that information through fear. When information becomes emotionally charged, perception becomes selective and objective decision-making disappears. The goal of trader development is therefore psychological clarity. A trader must be able to access everything they have learned about market behavior in any given moment. Fear blocks that access by filtering perception. When fear is removed through acceptance of risk and probabilistic thinking, the trader can observe patterns, trends, and opportunities clearly. Objectivity is simply the ability to see market information without emotional distortion. Every trader operates within a personal version of reality, shaped by perception. The market constantly expresses information through price movement, but each individual can only perceive what their mind has learned to recognize. Two traders may look at the same chart and see entirely different things. True shared reality would require both individuals to perceive every possible distinction the market expresses in that moment. Anything less means each person is interpreting the environment through their own internal framework of beliefs and knowledge. When traders first encounter price charts, they see only meaningless lines. There are no patterns, no signals, and no opportunities because the mind has not yet learned how to interpret what it is seeing. Over time, through study and experience, the trader begins to recognize patterns, symmetry, structure, and behavioral tendencies in price movement. These distinctions gradually transform what once looked like random lines into meaningful information that suggests potential opportunities. However, even experienced traders do not perceive everything the market is expressing. Each trader has only learned a portion of the possible distinctions within market behavior. If a trader has learned to recognize 30% of those distinctions, then their effective reality in any given moment is limited to that 30%. Consistent performance requires having conscious access to all the knowledge that has already been learned about the market. Fear interferes directly with that access. When a trader operates under emotional pressure, perception narrows and parts of learned knowledge become unavailable. The trader literally cannot see opportunities or risks that would normally be obvious. The more fear dominates the mind, the smaller the percentage of accessible perception becomes. In extreme cases, fear can reduce awareness so dramatically that the trader reacts impulsively rather than analytically. Consistency, therefore, requires learning to operate in a carefree state of mind where market information is perceived without emotional distortion. Price movement itself is neutral information. Upticks and downticks only become psychologically painful when the trader attaches meaning related to being wrong, losing money, or missing opportunity. Removing that emotional charge allows the trader to observe the market clearly and respond with discipline rather than reaction. Achieving this state requires an active process of changing beliefs. The trader must deliberately adopt beliefs that reflect the true probabilistic nature of markets. Every moment is unique, outcomes are randomly distributed within an edge, and certainty about the next trade is unnecessary. The closer a trader's beliefs align with these truths, the less fear influences perception, allowing the trader to execute consistently with clarity and confidence. A trader must eventually recognize that the goal of trading is not to make money immediately, but to develop the mental and behavioral skills that make consistent profitability possible. Money becomes the natural byproduct of skill. When traders focus primarily on profits, they reinforce emotional reactions to individual outcomes. When they focus on skill development, they create a psychological environment where discipline, patience, and probabilistic thinking can grow. The core objective of training is to internalize the fundamental truths about the market at a deep level of belief. These truths cannot remain intellectual concepts. They must become part of the trader's identity so that decisions are made without internal conflict. When these beliefs are fully accepted, the trader naturally thinks in probabilities, accepts uncertainty, and executes their edge without fear or hesitation. One effective way to train the mind is through a structured trading regimen built around a mechanical system. A mechanical approach removes subjectivity from decision-making. Entry conditions are clearly defined, exits are predetermined, and there is no room for interpretation. The purpose of such a system is not necessarily to maximize profits, but to create an environment where the trader can practice disciplined execution without emotional interference. Mechanical rules serve as a psychological training device. When the rules are precise, the trader is no longer deciding whether a trade should be taken. The only task is execution. This eliminates the internal debate that often triggers fear, hesitation, or impulsive action. By repeatedly executing clear signals, the trader gradually builds trust in the process rather than focusing on individual outcomes. The training process should also be organized around sample sizes of trades instead of individual results. Instead of thinking about the next trade, the trader commits to executing a sequence such as 20 or 30 trades. This approach mirrors the logic of probability. Just as a casino relies on many repetitions of its statistical edge, the trader must view performance over a series of trades rather than judging success or failure from a single outcome. Through repetition within a structured sample, the trader begins to experience the random distribution of wins and losses firsthand. This experience gradually dissolves the emotional need to predict each trade. The focus shifts from being right on the next trade to executing the plan consistently across the entire sample. Over time, this disciplined process builds the psychological stability required for true consistency in trading. A disciplined training process requires traders to evaluate their system only after completing a defined sample of trades. During the sample, no variables may be changed. Adjustments in the middle of the process destroy the integrity of the test because they interrupt the statistical distribution of outcomes. Only after completing the full sequence can the trader evaluate whether the results are satisfactory or whether the variables should be refined and tested again. The purpose of committing to a sequence such as 20 trades is psychological training. By focusing on a group of trades rather than a single outcome, the trader begins to internalize a critical truth: the next trade is unknowable. Even if a system historically produces a high percentage of winners, it is impossible to know which specific trades will win or lose. The edge only expresses itself across a series of outcomes, never in any single event. This uncertainty requires flawless execution. Analysis alone cannot generate profit. Only the act of executing trades according to the plan can produce results. A trader must therefore learn to take every valid signal without hesitation, regardless of what happened in the previous trades. The objective is not to avoid losing trades, but to execute the system consistently so that the statistical edge can unfold over the sample. Difficult moments appear when recent outcomes influence expectations. After several losing trades, the mind may strongly believe the next signal will also fail. The trader feels internal resistance and hesitation. These moments are crucial for psychological development. When a trader executes the trade despite those conflicting thoughts and the outcome proves profitable, the mind begins weakening the beliefs that previously created hesitation. Each time the trader confronts fear and executes correctly, emotional energy is removed from conflicting beliefs. Over time, the mind stops resisting the process. Eventually, the trader can complete an entire sequence of trades without internal conflict. At that point, execution becomes natural and automatic, indicating that the fundamental probabilistic beliefs about the market have been integrated. This transformation also changes the relationship between expectations and reality. Expectations are mental projections of what the next moment should look like. When reality matches the expectation, the mind feels satisfied. When it differs, emotional discomfort appears. The trader's task is not to force the market to meet expectations, but to adopt beliefs that align with the uncertain and probabilistic nature of the market itself. Human nature naturally seeks the fulfillment of expectations. People want reality to match the picture they have already formed in their minds. If beliefs were perfectly aligned with the way reality actually works, every expectation would be fulfilled and individuals would exist in a constant state of satisfaction. The fact that this does not happen reveals a mismatch between beliefs and the structure of reality. When expectations repeatedly fail, the logical conclusion is that the beliefs generating those expectations must change. In everyday social environments, people often attempt to resolve this mismatch by exerting control over others. By influencing behavior, persuading people, or shaping circumstances, individuals sometimes force the environment to conform to their expectations. This strategy may work temporarily, but it always carries consequences because others naturally resist behaving in ways that contradict their own beliefs. Harmony would only exist if everyone already shared the same belief structure. The market operates under completely different conditions. It cannot be controlled, negotiated with, or persuaded to behave in a way that fulfills personal expectations. Price movement reflects the collective decisions of countless participants. Because traders cannot control the market, the only element they can truly control is their own belief system. The trader must therefore align personal beliefs with the probabilistic nature of market behavior. When beliefs are not aligned with probability, performance becomes inconsistent. A trader may still experience profitable trades or even winning streaks, but the results will remain unstable. Emotional reactions, impulsive decisions, and misinterpretations of market information will continue appearing. These inconsistencies eventually produce damaging drawdowns that erase prior gains and reinforce frustration. The opposite condition occurs when the trader's beliefs align with the probabilistic structure of the market. In those moments, there is harmony between the trader's state of mind and the information the market is providing. Decisions feel clear and natural because there is no internal conflict. Many traders describe this state as being in the zone, where perception is sharp and execution feels effortless. However, the moment the trader begins overthinking or questioning the process, that harmony disappears. Awareness shifts from direct interaction with the market to internal analysis and doubt. The trader falls out of the zone and returns to emotional interpretation. Maintaining consistency, therefore, requires disciplined mental structure, often supported by precise rules that eliminate unnecessary judgment and allow the trader to distinguish clearly between market information and internal psychological reactions. A trader once attempted to implement a simple and precise strategy based on clearly defined support and resistance levels. The rules were straightforward. If the market reached support, he would enter at a specific price and risk only 3 ticks. If price moved 3 ticks against him, he would exit immediately. If the market moved in his favor, he would hold the position until resistance, take profits, and potentially reverse with the same predefined risk. The structure removed ambiguity and required only disciplined execution. When he attempted to follow the plan in real trading, his psychological reactions overwhelmed the system. As price approached the planned entry, he became convinced it would never reach the level and entered early. When the market continued to his original entry point, fear took control and he exited with a small loss. Then the market reversed exactly as the strategy anticipated. Instead of following the rules, he allowed emotional anticipation and fear to dictate his behavior. The same pattern repeated for several days. Even though the risk was small and the strategy clear, he could not execute consistently. Over time, he improved slightly and began entering closer to the correct levels. However, another fear emerged. Once the trade moved in his favor, he became afraid that the market would take his profits away. As a result, he exited positions after only 1 or 2 ticks of profit, even when he had correctly entered near the high or low of the day. Frustrated by these missed opportunities, he attempted to solve the problem by increasing his position size dramatically. Instead of learning to hold profitable trades, he believed larger size would produce larger profits quickly. The result was predictable. The increased emotional pressure amplified his existing weaknesses, and he quickly lost not only his recent gains, but additional capital as well. After this experience, he finally became willing to train his psychological discipline. The exercise he received required entering the trade exactly according to the rules and then physically removing himself from the decision process. Once in the position, he had to place his hands in his pockets, turn away from the market, and look at the clock while remaining in the trade until either the stop was hit, the profit objective was reached, or 20 minutes passed. At first, he could tolerate only a minute or two before the emotional discomfort became overwhelming. However, by repeatedly confronting that discomfort instead of escaping it, he gradually increased his tolerance. Over time, he learned to remain in the trade without interfering. The key lesson is that traders must confront their internal conflicts directly. Avoiding psychological discomfort prevents growth, while facing it deliberately allows the discipline required for consistent performance to develop. Mastery in trading requires the willingness to face psychological discomfort rather than avoiding it. When internal conflict appears during a trade, the trader must learn to stay present with that tension instead of escaping it through impulsive decisions. Growth occurs when the trader embraces the discomfort and continues executing according to the plan. The willingness to confront these internal reactions directly determines how quickly a trader develops the mental discipline required for consistent performance. Long winning streaks are not as unusual as many traders believe. Under the right conditions, sequences of 30 or even 40 winning trades can occur. These outcomes are not the result of prediction, but the combination of a sound edge and the proper mindset. When the trader operates with emotional neutrality and probabilistic thinking, technical skills can be applied with full clarity. The mindset unlocks the potential of the strategy, rather than the strategy creating the mindset. Many traders mistakenly believe that studying charts, indicators, or market structure will automatically produce the psychological state required for success. Technical knowledge alone cannot create the mindset needed for consistent trading. Without the appropriate psychological foundation, even the best analytical tools will be used inconsistently. The trader's reactions to wins, losses, and uncertainty will continually interfere with disciplined execution. This is why trading success is fundamentally about understanding human reaction to uncertainty. The market constantly presents situations that challenge emotional stability. Fear of loss, fear of being wrong, and fear of missing opportunity all emerge from the trader's internal belief structure. Unless those beliefs are aligned with the probabilistic nature of markets, technical skill will always be undermined by emotional interference. Some traders ask whether it is better to develop personal trading skills or simply invest with someone who already possesses them. The answer depends entirely on the individual's objective. If the goal is simply to grow capital, delegating the responsibility to a skilled trader may be the logical choice. If the goal is personal mastery of trading, then the path requires direct engagement with the psychological and technical challenges of the profession. Ultimately, every decision must be evaluated within the context of personal goals. Trading is not only a financial activity, but also a psychological discipline. The correct path is the one that aligns with what the individual truly wants to achieve. Once that objective is clear, the trader can commit fully to the process that leads to the most satisfying and meaningful outcome. Thank you for watching until the end and being part of this journey. Share this video with another trader who is working on discipline and building their mindset in the markets. Write in the comments, "I am in the process." Because becoming a consistent trader does not happen overnight, it is built through discipline, patience, and the process.